What's up, guys? I read an article today and I just want to share a little bit about it. So it was an article where they were talking about Charlie Munger and some trouble that he sees upcoming in the economy in the US. So I'm going to share this article and chat about it for a minute. Just going to flip the screen around real quick. All right. So here we are. The article is called Charlie Munger Sounds the Alarm on Issue That Could Bring Down the US Economy. Of course, it's a very clickbaity title, but it's got some interesting information I've been hearing about for a little while, and I want to share it. So it starts off talking about how Munger sees this being similar to 2008, and he's talking about commercial real estate in this situation. It says, billionaire investor Charlie Munger, vice chairman of Berkshire Hathaway, sees trouble ahead for the U.S. financial system because American banks are full of bad loans due to falling property prices in the country in a situation that seems very similar to what caused the banking crisis in 2008. Now, this article goes on to say that unlike 2008, the bad loans this time are in commercial real estate sector, not the housing sector like it was 15 years ago. And then it says that the potential for devastation is still here. So they go over how it's not nearly as bad as it was in 2008, but trouble happens to banking just like trouble happens somewhere, or just like trouble happens everywhere else. I thought this was a great little quote on, in good times, you get into bad habits, and when bad times come, they lose too much. And it says the Berkshire Hathaway vice chair told Financial Times in an interview. So that was a Munger quote. Again, in good times, you get into bad habits. When bad times come, they lose too much. Now, there's a quote that I think of, a quote comes to mind, and I believe it was Dave Ramsey who said, although this might have been Buffett, and Dave Ramsey quoting Buffett in a book, but basically when the tide goes out, you can tell who's been skinny dipping. So kind of just all stocks are basically just raging up into the right, and people who are investing with zero fundamentals in mind and are just throwing money into things because there's hype, they can be making a lot of money through that. And when the tide goes out, as in when things start crashing and when the market starts becoming more of a weighing machine as opposed to a voting machine, as Benjamin Graham puts it, when things start going to crap, you can tell who's been skinny dipping. So say you buy a bunch of super hyped companies, and then all of a sudden, over time, it's proven that these are not companies that are very profitable. They're not large cash printing enterprises. They are not producing a lot of cash flow. Eventually, the market will correct, and those investors will lose a lot of money. And you can tell they've been skinny dipping. So goes the quote. So back to this article first. So again, he's talking about commercial loans, and Munger says that banks are already pulling back from lending to commercial developers, as every bank in the country is way tighter on real estate loans today than they were 6 months ago. He says that they all seem to be too much trouble. So as interest rates go up, the payments to service these loans will also increase. This around again. So as interest rates go up, the amount of money that goes to interest rates for every payment goes up, meaning the overall payment and the amount to service the loan is increasing. So as interest rates go up, it becomes a lot less satisfactory and a lot less appealing to borrow. And also this means that there's more risk for lenders, as other people might not be able to pay off these loans as much or as easily. Back to the article for a minute. So Munger is talking about how banks are tighter on real estate loans right now. And then we get into, at the end of this, it just goes into how Elon Musk is also talking about how the commercial real estate situation is a huge issue. And I found this tweet interesting. The Kobasi letter, I don't know who that is, but basically they're talking about how over the next 5 years, more than 2.5 trillion in commercial real estate debt will mature. They say this is by far more than any 5-year period in history. So that's a pretty crazy little bit of data. Whoops. And then it says, meanwhile, rates have more than doubled and commercial real estate is only 60 to 70% occupied. Refinancing these loans is going to be a crapshoot, basically. Oops. So something that I learned sometime either earlier this year or last year is that commercial real estate is very often variable interest rates. So with variable interest rates, as time goes on, the new rate will adjust with where current rates are. So there was a huge real estate boom in 2020 and 2021 during the pandemic and onwards, and interest rates were lower. Fast forward a few years, pandemic isn't so much a concern anymore, but interest rates have gone up a lot. So that means these existing commercial loans that were taken on during the pandemic are going to need to be readjusted as far as the interest rates, and that is going to increase the amount of money that needs to be paid for each debt payment. And as this happens, the same time commercial real estate is having a lot more vacancy. That tweet just talked about there being 60 to 70% occupancy in these buildings. So if a lot more buildings have fewer tenants, and at the same time there's a trend of decrease in cash flow from tenants, meaning a decrease in lease payments being paid to the property owners. Meanwhile, at the same time, the property owners are having to pay a larger expense to pay off their debt for these buildings. So that could be pretty hazardous, and we'll see how that pans out. Could get interesting out there. There have been a lot of different people in finance that have been talking about this issue, and could be a pretty big issue, so we'll see what happens. Anyway, just wanted to share that. See you guys.